Right. So, as you know, the real question when it comes to these kinds of tokens is whether or not they are a commodity or a security. A security we think of as being a black box. The person who is selling it knows a lot more about it than the person who's buying it. So we have regulations that require disclosures. It's so the person who's buying truly understands what they're getting. If it's a commodity, in this case, a digital currency, then everyone knows what it is, right? And it's an actual medium of exchange. Technically, Bitcoin has been defined as a commodity. It is a currency that's used on an established network, and it is used for the purpose of exchanging funds, exchanging value. And so that means that technically it is a commodity, and so it's not treated in the same way that a security is.
Interesting. I mean, as Bitcoin and some of these other cryptocurrencies continue to gain traction, you see more institutional money coming to this commodity as well, if you will. Is it just inevitable to think that we're going to see some sort of regulation drafted, whether it's here in this country or even maybe on a global perspective?
Well, we've already seen several bills proposed attempting to establish a new regulatory framework. See, the issue with regulations is that our securities regulations, by that I mean securities and commodities, are really designed in response to crises. And so they're very good at dealing with the risks that were raised in the crisis that they're now regulating towards. The issue with something like Bitcoin that's new is that then you have to put this very new innovation on an old framework. What I mentioned prior is that it's important that the regulation not be fear-based. And by fear-based meaning that it's not just a response to something that's new and just pushing back on the new and trying to force it into old boxes, but really regulation that's really based on risk. Figuring out exactly what are we concerned about. Are there entities within the market that are significant, that could really lead to knock-on effects in the market? And as such, then, what is that risk? Who are those entities? And then what is the wisest, most reasonable way to defend against that risk without killing innovation? Because we don't want to have Americans who have great and brilliant and new ideas going offshore or being stymied because regulation is broad brush and not focused on the risk it's trying to prevent. And so I think that there have been many discussions about regulation. It's very likely, given the possible heads of agencies who have deep crypto fintech background, that there could be regulation. My hope is that that regulation, however, is based on the data, on the risk. It's targeted and not just based out of fear.
I wonder what you think about another trend we're seeing take root. I mean, MicroStrategy is in focus as a company we cover pretty closely on this show, but it's in focus again today. Those shares are under pressure after the firm revealed plans to sell convertible debt to buy more Bitcoin. It now holds billions worth of Bitcoin instead of cash for reserves. You saw that news last week with Tesla. Corporations replacing dollars with Bitcoin or other types of cryptos. Is this a trend we're going to see more of? Or is this something that could potentially be an area where regulators do take a much closer look?
I think whenever you have significant players in the market who could affect the overall economy potentially, right? That's how regulation is largely designed. A lot of it is based on making sure that those who are significant individuals, that there's enough oversight into what they're doing in areas that could lead to risk, because their risk can lead to risk for other people. And so I do think that being that you have these significant players who are demonstrating a commitment to Bitcoin, it's likely, I can't say for sure, it's likely that you'll see more of that as it becomes more accepted. So I do think that could be a trend. And as you see people or entities of significance having more holdings, naturally, the regulators that are focused on those entities will take notice. But I think, in doing that, it's important that the regulation is targeted. It's facts and circumstances based. What exactly is the concern, and how can we mitigate against it? Do we need more disclosure? Do we need some kind of demonstration of proper collateralization, if appropriate? to ask the reasonable questions based on the risk, but work backwards from the risk to the regulation, not just the regulation to prevent something that seems different, new, and therefore scary, but rather to start there.
Shepard Smith here. Thanks for watching CNBC on YouTube.